Hi everyone, welcome to today's webinar. Before we begin, we want to cover a few housekeeping items. To the right of your screen, there are multiple application engagement tools that you can use throughout the presentation. If you have any questions during the webinar, you can submit them through the Q&A engagement tool. When submitting a question, please note that you do have the option to stay anonymous. To find additional session documents, click Details at the bottom of your screen. Then click View Full Session Details. Here you can find session-related content to download such as PowerPoint slides, relevant documents, and more. As a reminder, this presentation is being recorded for replay purposes. This recording can be found in the Attendee Hub and will be available as an on-demand video an hour after the webinar has concluded. Lastly, don't forget to take our post-event survey. This can be found at the homepage of the Attendee Hub. Now, let's pass it over to today's speakers.
We just have a couple more quick housekeeping items. We'll be having polling questions during the presentation. Polling is located directly underneath the Q&A functionality to the right of the user's screen. You will need to pop it open to answer the questions. Also, we encourage attendees to ask non-anonymous questions. This way we can get back to you following the presentation if your question is not answered. Thank you and for joining us today, and welcome to our webinar where we'll be focusing on the provisions of the Inflation Reduction Act that will have the biggest impact on your multifamily projects. I'm Don Bernards. I'm in charge of our multifamily transaction advisory services team. We're working with for-profits, nonprofits, public housing authorities around the country, helping to structure and advise on financial resources for their multifamily deals. The IRA, of course, ties very, very well into what you're doing with your multifamily projects. And I strongly believe, and I think you'll over the next 45 minutes, learn that you should definitely consider one or more provisions of the IRA for your multifamily project, be it new construction, be it you're doing asset management for your current portfolio. We're going to turn over to Chad Resner in a few minutes to get into some details, but what is very exciting about the IRA is that, and multifamily, is there are a number of provisions, credits, rebates, which are really helping to pay for a large percentage of your capital expenditures around solar and electrifying your systems. So all of a sudden, when you're looking at return on investment, if I'm covering a large percentage of my capital, it kind of seems like, quite honestly, a no-brainer to start looking at it, right? If I'm combining solar and low-income housing tax credits, for example, there's no longer a reduction eligible basis. And for a 4% deal, if you're in a qualified census tract or not, you may be as much as 75, 85% of your total capital expenditures paid for solar, for example, in a solar and light tech transaction. In a 9% tax credit deal, depending if you're capped and you have excess space, if you're not capped, you can actually generate 100% or more of the cost of solar and related equipment. So very exciting to look at the capital. Then kind of moving into, you think about what's our next steps. So I got my capital almost paid for. What is the utility savings, which I think is just extremely exciting. Maybe sharing that, and there's actually an additional credit we'll get into, or a percentage if you share your benefits with your tenants. Maybe you're just cutting down common area utility. Maybe you're looking at what the whole load. Maybe you're going to look at owner-paid utilities as opposed to having tenant-paid utilities. So just a lot of things. We're kind of working on scenarios and modeling with a lot of developers right now. What are the benefits? We're also going to touch on a little bit. We're still waiting, unfortunately, for a number of provisions to be finalized. Things around, applying for some additional credits around solar, some of the rebates. We don't have all the information yet, so we'll get into that. And I think one of the most exciting things is for the next 10 years, this is in law. Many of you are familiar with the old 45L energy efficiency credit, where it expired, it was renewed after the year ended, it expired, so you couldn't really plan for it. This is in law for the next 10 years, so something you can definitely plan for in your multifamily transactions. Now with that, I want to turn over to one of my partners here at Baker Tilly, Joel Lobenstein. Joel?
Thank you, Don, for that overview, and great to be on another great Baker Tilly IRA webinar. I live and I'm a partner within our energy and utilities practice. So for 15 years at Baker Tilly, and for 5 years before that, all of my work revolved around renewable energy and energy efficiency projects, initially as a developer, and for the last 15 years, helping developers across a number of verticals get energy projects done. And, the IRA can't be overstated enough, is like nothing I've seen in my career in the energy sector. And Don put it really well together. There's a lot to uncover after you get a base understanding of the credits that Chad is going to go into here shortly and what's available. And want to reemphasize, this is a 10-year program. So there's a lot of benefit in rolling up your sleeves now and starting to understand and taking the time to understand the opportunities, because there's a lot just beyond the credit by way of understanding the nexus between energy, housing credits. Every location can be a little different, and there's a lot of opportunity to be uncovered as a result, as it relates to the devil being in the details on energy project development at distributed generation scale, which is what most of these types of opportunities will involve. So look forward to participating in the webinar. With that, I'll turn it over to Chad Resner, who's going to be driving the presentation, and we look forward to your questions as we go along.
Hi, good afternoon. Thanks for joining us. My name is Chad Reisner. I'm sitting in Madison, Wisconsin. I am in, I guess, the construction real estate group, and I am also specifically designated to the statutory credits group here at Baker Tilly. So real quick, let's just get started. As Don mentioned, there's a lot of credits that can apply to multifamily housing and different things that can work. So first of all, I guess we'll kick off our first polling question. Has your organization discussed the IRA so far? If you can, go ahead and please answer that in the polling question. And I might need some help from someone else if things aren't working, but okay. Sorry, I apologize if there's any kind of problems with technology, all on my end, all my fault. But if something's happening, anybody just jump in and let me know if something's going wrong or that we need to do something different. Okay, so let's get started with Section 48. First thing we want to talk about is the investment tax credit under Section 48. So certain property that is eligible property for under the code can earn a credit. So this is a credit. This is not a deduction. There's one thing we'll talk about that is a deduction, but this is the credit. And so this is sort of a general outline of how the 48 investment tax credit works. There is a base percentage. And what we're going to talk about here, this base percentage, this bonus 5 times, this different adders and credits, that's going to apply throughout the Inflation Reduction Act. So this is going to be some common themes that we're going to hear over and over again. But the way the Section 48, the investment tax credit is, you're going to start with a base of 6%. Eligible cost for the property, 6% of that is your credit amount. There's this prevailing wage and apprenticeship requirement, and we'll talk about it a little bit more, but we won't get too in-depth into that. If you meet those requirements, or if you're a small enough project, and we'll also talk about that, you get this 5 times bonus thing. But the important thing right now is you start with the 6%, you can get this 5-time multiplier, you go to 30%. Then there's these different adders that can take that percentage up. Domestic content bonus, you can go up another 2 to 10%. Energy community, you can go up to another additional 10%. Low income communities can add another 10 to 20%. So you can see where this is going. We started at a 6% credit, and we're adding all these things to it that the percentage can actually get to be a much larger number. One of the things the IRA did was it allowed certain credits to be transferable. The Section 48 credit is transferable. So that means you can sell the credit. So if you can use the credit, great. If you can't use the credit, there is an opportunity to sell the credit. So anything starting 1/1 of this year after, you can sell those credits. There is a basis reduction. So for the Section 48 credit, 50% of your credit amount reduces the basis of the asset. So less depreciation going forward. There is a catch. Section 42, the affordable housing basis, the eligible basis for your Section 42 credit is not reduced for this. So that this is a really good thing for the affordable housing industry. Okay,
And on that last point, Chad made.
Oh, Don, you went mute.
Chad, sorry about that. And just to hit on what Chad's last slide, right, we said the 6, the 5, there's like a lot of numbers there, right? But really think of it, and we'll get into this. A lot of solar will start for multifamily, will start at that 30% base. Domestic content, there's ways, and we can talk about that. You'll be at 40. Now you add in some of these other adders, low-income communities, and some of the other things Chad mentioned. You might be 40, 50% is what we're seeing as really kind of a true base. Again, no further reduction in eligible basis, which was a huge kind of detriment in 4% tax credit deals. So now we're at 40, 50% base solar, adding that into your, so that's great if you're a market rate deal. If you're affordable, now you get to add on, it's the same basis, no reduction. So that's how we're getting such a big impact. Chad.
So just some basics on the 48. So remember, this is the cost of your eligible property times your percentage, the energy percent, the percentage that we got to under the credit numbers. So Section 48 does not cover just one type of property. There's multiple properties that it covers. And here at the bottom of the slide, we've listed types of properties that you will commonly see in multifamily buildings. So you have solar panels, geothermal heat pumps. If you put in a storage system, a battery, microgrid, any of that is also eligible basis. So you can see the whole list there, but these are the types of things that if your project has, you're considering, et cetera, reach out or at least know that this is a possible credit for you. Couple requirements to get to Section 48. Taxpayer has to be the original user. It means you either constructed it or you owned it on the date, placed in service. Typically, you're not going to construct it yourself. You're going to hire somebody to do it, but you hire somebody to build it and you're the owner on the date placed in service. The placed in service date is the date the credit is earned. If you are the owner, you get the credit on that date. The property must be depreciable. The IRS can issue guidance that requires certain performance and quality standards. So that's just, they haven't issued any yet, but they could. Again, the base percentage starts at 6%. For some property, it's 2%. Everything we've covered and most of the Section 48 property is the base 6%. So what you're typically looking at for multifamily Section 48 credits, you're going to start with a base of 6, 5 times multiplier, et cetera, and build it up from there. There is a rule that if it's financed, the project is financed with tax-exempt bonds, there may be a basis reduction. And again, the final point down here at the bottom of this slide, the basis is going to be reduced for 50% of the amount of the credit. If you're doing a historic deal, you cannot count the basis that you take for the credit for QREs. It does reduce your basis for QRE determination purposes. But again, Section 42 eligible basis is not reduced by the basis reduction. So it's good for affordable housing, not so good. It's still good, but it's not as good for historic rehabilitation projects. Okay. In the middle here, this is sort of an important point, the 3 ways to qualify for the 5 times multiplier. So the 6 to the 30% where we're getting to. The first thing that's very important to remember is if a project has a maximum net output of less than 1 megawatt, you don't even have to worry about the prevailing wage or the apprenticeship requirement. You're good to go. You get the 5 times multiplier. There is also a begun construction, but that had to be, you already had to have begun construction. It had to start by January 29th. So you had to have already started. The reason I left this in, or we left this in, is if you have a project currently under construction that's over 1 megawatt, realize there may be another way that you don't have to meet the prevailing wage and apprenticeship requirements. And of course, the final way to get the 5 time multiplier is you meet the prevailing wage and apprenticeship requirements. Okay, we've got some slides in here on the prevailing wage and apprenticeship, and what we're really going to do is try and cover sort of just some big talking points, things to keep in mind and consider, because in practice, I think the way this is going to work out when you're in the process of building or developing a multifamily project, you're not going to be looking at the wage reports. You're not going to be in the weeds of how many apprenticeship hours are put into your project. What's going to happen is you're going to deal with the general contractor. So whoever's building the project, and I can tell you, we have had a lot of conversations with general contractors, and we continue to have them. They are well aware of prevailing wage and apprenticeship requirements, and they're working on how to document it. So the IRS has issued guidance. What do you need to do if you are the owner or developer of a multifamily project? You need to satisfy the prevailing wage requirement, and you need to maintain and preserve sufficient records. You do not have to attach those records to your tax return, but it's part of your file. So if you were ever audited, you should have this support. And again, the way I envision this working, your general contractor is going to know what you need. They're going to compile this information for you, and they'll provide it over to you. The upfront conversation you have with the general contractor is going to be, will I meet prevailing wage, or I want to meet prevailing wage? Have that conversation as soon as possible. We found out a lot of, so the law came out and it applied to some projects that had already started. Going back and trying to figure it out is difficult. Couple of the terms. So when we say prevailing wage, you have to pay the certain rate for the type of worker in the geographic location that you're located. You must meet this prevailing wage standard. And there's a whole process where you can get a determination of what that wage level is. The thing to keep in mind, it's not just the amount of money paid to the worker. It includes all fringe benefits and other things that the worker can get. The second definition or term I have here, or we have here, is construction, alteration, or repair. The thing about this that I want to point out is there is this theory that it covers the work on the site. So this is historically applied to like government projects. So the site of work theory was a lot easier to apply. It was the project right there where everything was going on. Now you're going to have these sort of smaller one-off projects. What if you put solar panels on top of a multifamily building? Does this prevailing wage requirement apply to the contractor coming in to put the solar panels on only? Does it apply to the entire project? That's a question that's come out, and we're waiting on guidance. Hopefully it will apply only to the contractor doing the solar panels, but to be determined. We're still waiting for a little more guidance on that. The apprenticeship requirements. So basically what the apprenticeship requirements is a certain number of hours worked on the project, or whatever that definition is, whether that qualifying project is, have to be performed by a registered apprentice. So that's what you have to satisfy, that's the labor hour requirement. The applicable ratio requirements are subject to any local rules. There may be local where the project is being built requirements as to how many apprentices you have to have. You have to satisfy that. The apprenticeship participation requirements, if you have 4 or more, any contractor with 4 or more workers on a project, they have to have at least 1 apprentice. So, and then you meet all of this, you have to maintain your records. Again, what I envision would happen here is the general contractor is going to generate the reports, the documentation you need. That's going to be part of what is given to you. You're going to maintain that in your files. And that's going to be your support for taking the credit that you do.
And one quick item on that, as Chad noted earlier, there is one caveat to all of what Chad just said around, prevailing wage and so forth, is if the maximum net output is less than 1 megawatt, which I think many, typical structures, solar structures and so forth, will be less than that. But that's just something to confirm as well. So thanks, Chad.
Okay, so our first bonus or adder that we have here, this is domestic content. So basically, what you buy for your project needs to be domestically made. There's a rule for the steel and the iron. Any steel or iron in the renewable project has to be 100% manufactured in the United States. Now, any other manufactured products need to be mined or produced, the applicable percentage of those products, and that needs to be 40%. And again, I know general contractors are all over this and they're really looking into it. Typically, what I've seen or heard that they're doing is they will have a letter that goes to the supplier of the materials that go into a project where there's certification that you meet these standards. So again, this is one of the things to talk to whoever is doing the renewable energy project. Just a question you can have for them. Do you meet the domestic content standard? Will I get the additional 10%? And again, down here below, it's 2 or 10% if you meet the prevailing wage and apprenticeship, or you're accepted, because like Don said, you're less than 1 megawatt, you get the 10% automatically, but it's 2 or 10% depending on where you fall if you meet the domestic content requirements.
As Chad alluded to, we're kind of looking at, how do we verify that? How do we certify, right? It's not a cost certification per se, but it's a domestic content certification. So maybe an investor would want something. So we're kind of, the industry is looking at what does that kind of reporting look like?
Yes, and then there's still a lot to be fleshed out on exactly what reporting and what records you need to keep. Hopefully in additional guidance, we'll get a little more looking into this. So I guess we have the next polling question. I think it's okay if I flip forward while the question is up, but someone stop me if that's not right. Okay. The next adder or the additional bump in the credit that we have is for an energy community. So I won't read the full definition for you, but you're looking at a brownfield site or an area that is impacted by oil, natural gas, coal, certain requirements. If you are in a census tract that meets this definition or adjacent to a census tract. So the thing to know about this credit is it's all just where your project is located. You can't do anything different to get it or not get it. It's just where the project is located. And there are maps out there, and I believe Baker Tilly has a map developed that will be deployed shortly, that you can type an address in, it'll pop up, and it'll tell you, yes, you're in an energy community, or no, you're not in an energy community. If you are, you qualify for 10%. If you're not, you don't. Again, this one also has, you start with 2% if you don't meet the prevailing wage and apprenticeship requirements, assuming you're required to. Goes to 10% if you do meet them. So anytime we say that meet the prevailing wage or apprenticeship requirements, it also, under 1 megawatt, you're automatically deemed to meet them and you're good. The begun construction also would apply. Okay. This next one, this is not like the 2 credits we just talked about. So domestic content and the other one, and what we just talked about for the energy community, if you qualify, you just claim them. So you're going to look at your facts and circumstances, determine if you are eligible for this credit, and you're going to take it. You're supposed to keep the records, and that's it. That's the way it goes. So the environmental justice is allocated by the government. There will be an application process. So it can be a 10% or 20% adder, up to one of those 2 numbers. Each year, the government has 1.8 gigawatts of power to allocate. So if you have a renewable energy project you have on your multifamily building, so if you put solar panels on it, you're going to look at the total power output you have. You can apply if you're in one of the qualifying groups, and we'll talk about that. You can apply for an allocation equal to your power output. So if you had, I'm just picking a megawatt because that's a number, but if you had a 1 megawatt project and you apply for it and get 1 megawatt, it's what you were allocated over your project usage or electricity. 1 megawatt over 1 megawatt, you have the ratio of 1 times this 10 or 20%. If you get half of an allocation of your megawatt, it would be a 1/2 ratio. So if you had a 10%, you'd get a 5% credit. So the application process is not out yet, or I have not seen it. Shortly before this morning, I have not seen it. So as you can tell in the code, it was stated that the government has 180 days to issue guidance. The 180th day from the enactment of the IRA is February 12th. We're February 8th. So we're 4 days away. So one thing we could say is good news. We should be getting guidance very shortly. I would caution that optimism a little bit because it is the government that has to issue guidance. What's going to be done to them if they miss the deadline? And we've seen that with some of the other guidance that Congress put specific deadlines on. What are they going to do? If the government doesn't do it, there's no real hammer here, if you don't meet this deadline. So I know there's a lot of guidance in the works. A lot of it is supposed to be coming out, but we're still in a wait and see when it does come out mode. Okay, so I flipped forward a little too quick. So the 10% credit is based solely on where you are located. So if it is located in a low-income community or on Indian land, low-income community is defined by the new market tax credit rules. So Baker Tilly has a website. You can go on there. You can search by an address to see if you fall within a new market tax credit area. So anywhere you do a project, you can just type in the address, pop it up, and see if you fall under this 10% number or on Indian land. That is just based on geography, if you're located there. Again, this is when you have to apply for it. So you start with 10%, and whatever portion of your total energy usage you get allocated to you is going to give you the ratio you multiply by that 10%. The 20% is a qualified low-income residential building project or a qualified low-income economic benefit project. So if you are one of those two defined terms, you start with 20%, multiply it by your allocated amount ratio. So what is a qualified low-income residential building project? So it is a facility installed on a residential rental building program or building that participates in a covered housing program. Covered housing program is also defined. So it is certain programs such as Violence Against Women Act of 1994. So if that's the housing program and you qualify under that, you are this qualified low-income residential building project. And in the red there are the definition of a covered housing program. So if you fall within that definition, that's step one. You're a covered housing program. Step two, the financial benefits from the electricity are allocated equitably among the occupants. So one of the things the code does say is reduced electric rates to the occupants of the building is something that will be considered as qualifying for equitably allocating the benefits. How much do the utility bills have to go down? We don't know yet. I mean, that's one of the things for future guidance. So there's some things on like this. General term is some of the benefits have to go back to the occupants. Exactly how much has to go back? How does it have to go back? These are some things that we're going to need some additional guidance on. Can you reduce the bills just a little bit? Does it have to be a certain percentage? Does it have to be everyone? Can you do something other than reduce the electric bills? This is stuff that is just unknown at this point in time, but there will obviously have to be some benefit to the occupants. So the second term or the second type of project that will qualify for the 20%, up to 20% credit under this program is a qualified low-income economic benefit project. And that's defined here on the slide, where 50% of the financial benefits are provided to certain income level households. So you got to have the households with a certain income level. And here we know at least 50% of the benefits. And again, a reduced electric bill does count as providing some of the benefits to them. And to our next question, would you like to meet to discuss your project or other IRA consideration?
Maybe I'll chime in there just real quick, Chad, while folks are responding to the question, because there are a lot of good questions in the chat. I'm totally convinced we're not going to get to them all today, but we certainly will follow up. But one of those questions ties to what you just kind of wound down, which is this concept of what we call stacking the credits. And the question was, if you meet all the qualifications, could you technically get a 70% credit for Section 48? And the answer to that is yes. So your 30%, which assumes you met prevailing wage or you're less than a megawatt, your 10% for domestic content, 10% for being in an energy community, all of which are entitlements if you meet those criteria, and then the competitive environmental justice credits that Chad just spoke to, which would give you a 10 or 20% potential option, getting you to that as I call it, the holy grail of 70%. So the answer is yes. In certain situations, there will be projects that will be eligible for a 70% credit, which is really exciting.
Yeah, that's actually a very good point that I did not point out. Each one stands on its own. So you qualify or you don't qualify. And there will also be recapture rules that will come out that are supposed to say that if you claimed a credit based on certain adders, turns out you don't qualify for one, you only lose that adder. You don't lose all of your credits. So you still qualify, whatever you still qualify for will not be recaptured, but maybe a piece of it will be recaptured. But hopefully we don't have anybody dealing with recapture of credit. We don't want to see that. Okay. The next credit we're going to talk about is 45L. So this is the new energy efficient home credit. This applies to multifamily when you lease a new apartment. So you construct an apartment, and we'll talk about all the qualifications and whether or not you do qualify. But if it meets certain energy efficiency standards, you can get a credit per unit. So where we start with the credit for multifamily, and there are two levels of energy efficiency, and we'll detail what those are here in a little bit on the slides. But if you're under the lower energy efficiency level, it's $500 per unit. If you are at the higher efficiency level, you're at $1,000 per unit. And again, here's where this prevailing wage requirement starts going into everything. What we talked about in 48, same rules for prevailing wage come over into the 45L. If in building the project, you meet prevailing wage, this credit amount per unit goes from 500 to 2,500. So 5 times multiplier, $1,000 to $5,000. The basis is generally reduced for the amount of the credit. But again, this is the second credit where affordable housing has that benefit. The Section 42 eligible basis is not reduced for the amount of the 45L credit claimed. So the 48 and the 45L are the two credits that 42 affordable housing basis is not reduced for. And that's a really good thing for the affordable housing community. We'll talk about transferability of the credits. We sort of hinted at it that some of these credits can be sold. The 45L credit is not one of those credits that can be sold. So the way the credit works is, we'll talk about some of these terms, but an eligible contractor that builds an energy efficient building sells to an unrelated third party. Leasing counts as selling. And again, the amount of the credit, this also lists the requirements. So what you have to be. So when I say there's a lower level under the $500 credit, you can see the requirements for energy efficiency. The 1,000 is the net zero energy. An eligible contractor is the person who builds it. It is not only, or it doesn't have to be the person who builds it. It can include a taxpayer who hires a third party to build a project for them. So in the multifamily, when you hire somebody to build the project for you, you become the eligible contractor for purposes of the 45L credit. So check that one off. We're good so far. Qualified new energy efficient home has to be located in the United States, construction by a certain date. That's the original enactment of 45L. So we're going back over 10 years. You're good there. And you have to satisfy the energy requirement. So you meet those, you have a qualified new energy efficient home. Construction is not just new construction, it can be substantial reconstruction or rehabilitation. And the definition of acquire is important, that it also includes leasing the property. To get the 45L credit, you must obtain a certification. Typically, it's going to be done by an engineer. Somebody who's going to come in based on requirements from the government, they're going to certify that you meet these energy efficiency standards. So that you got to have this certification. So there is an additional cost to getting the 45L credit. And again, basis is reduced by the amount of the credit. There's an exception for Section 42 eligible basis. The one thing to point out here is there was a 2008 notice. So the credit is per dwelling unit. The first part of the definition of dwelling unit in this 2008 notice is not surprising. Basically, it's got to be eligible for living. Got to have everything you need for a person to live in it to be a dwelling unit. That's sort of expected, not surprising. The last part of this is no more than 3 stories above grade in height. So if your apartment complex is too big, 4 stories or up, there is a concern that you are not eligible for the 45L credit. There are people out there saying that 45L was drastically changed by the IRA, and there were drastic changes to Section 45L by the Inflation Reduction Act. The big changes are in the energy efficiency. So any old guidance relating to the energy efficiency standards is pretty much assuredly out. I don't know that this really relates to the energy efficiency standard. And I guess where I come down on this is, I hope the 3-story rule is gone, but my concern is that it does still exist. So keep this in mind when analyzing projects. You may still be impacted by the 3-story rule. And I know there are people out there that will tell you, don't worry about it, it doesn't apply. I would say maybe. It's just a caution. Okay.
Hey, Chad, we have about 8 minutes, 7 or 8 minutes left. I think maybe we skip 179D, maybe go into 30C and a few of the rebates and then transferability.
Absolutely. And if anybody wants to specifically talk about 179D, reach out to us, definitely. So in the interest of time and also just be practical here, the alternative fuel vehicle refueling property, this applies to a lot of property. For multifamily, the only thing I can think of that it would ever apply to is electric charging stations. So again, like the other credits, 6% base of your eligible cost, wage and apprenticeship requirements are satisfied. This one doesn't have the under megawatt because I think all charging stations are going to be under a megawatt. I can't imagine a charging station being that large. I don't think it's even possible. So this one, you have to meet the wage and apprenticeship requirements to get the 5 times bonus up to 30%. The big thing about this credit is it's got to be installed within a certain geographic area. That geographic area is what is called a non-urban area. So the 2020 census results have recently been released. That defines what is an urban area and what is a non-urban area. And it's a very complex definition, but there is a map out there where you can go look. If you are in a non-urban area, you're eligible for it. If you are in an urban area, you are generally not eligible unless you are also in a new market tax credit area. And Baker Tilly does have a map that you can track to see if it is in a new market tax credit eligible area. If you are in one of those areas, even if you're urban, you can qualify for the electric charging station credit. This is one of the credits that is transferable. This is sort of stuff covered. Rebates. So Don mentioned earlier that there are also rebates out there. There are two basic rebate programs that we're aware of. There's the homes rebate, and I believe it's something, I'm trying to remember the exact term, high efficiency electric home rebate program. So the home rebate, or homes, it's called the homes program. That is for basically my understanding, and additional guidance is going to come out. So before I get into the rebates, I should say that the way these rebates work is they have reserved amounts to states. So every state has an amount that's reserved to them. The states will apply, say how we're going to run our rebate program. If it's accepted by the federal government, they are then allocated the reserved amount, and then they implement the program. So there is a time delay. These are not currently out there and available because you got to get through that process and get through the steps. On the government's website, they're saying that it might be the end of this year or even potentially early next year before these programs are up and running. So there's going to be a little bit of a delay. But the homes program is designed for if you have energy efficiency. So for multifamily buildings, you're looking at basically the energy cost savings you generate, that you cut. So if it's a 20% to 35% reduction, you can get up to $2,000 of a rebate per unit, up to a maximum of $200,000 for the entire multifamily building. If you go above 35%, it's $4,000 per unit rebate, up to $400,000 for the multifamily building. That applies to any multifamily building. There's also a definition of low or moderate income households. If 50% or more of the units in the multifamily building are low or moderate income households, those numbers I just gave you are double. You go from $2,000 per unit at the 20% to the 35% efficiency to $4,000 or 80% of your cost max. The above 35%, you go to $8,000 per unit, up to 80% of your total cost. The low or moderate income household is 100, or it's 80% of the area median income. So if the unit in the multifamily building is 80% or less of the area median income, they are a low or moderate income household for the homes rebates. The high efficiency electric home rebate program. Now, again, you can't, for the same cost, you can't get both rebates. You get one or the other for the specific cost. You can still get both rebate programs, but the same dollars can't qualify for both of them. This one's also going to work the same way. Amounts are reserved to the state. This one's also Indian tribes have amounts reserved. They're going to apply. It's going to be allocated, and there's going to be a process and a delay. This applies, and sorry about not flipping through all the slides, but over on the right here of this slide, this credit applies if you do certain things. This isn't just looking at the energy efficiency savings you have, it's if you put in one of these qualifying properties. And the way it works is that if you have a multifamily building and you have this one, you have to have low to moderate income residents. 50% or more of your residents in the multifamily building have to be low or moderate income to qualify at all for this rebate program. Low or moderate income for this rebate is different than the homes. This one is 150% of area median income. Now, there are different requirements if you are under, or different benefits if you are under 80% area median income or between the 80 and the 150%. So the amount of the rebate you can get could be capped at less. And there is an overall amount based on which group you fall into. And then there is an overall amount you can see on the right-hand side here for each type of property. So looking at the top here, if you are under 80%, 100% of your costs up to the amount per item covered. If you're 80 to 150, only 50% of your cost up to the amount per item. And I want to flip through the last couple of slides I have here, and I'm sorry if I run over or if I run it over. Again, what we talked about, certain credits can be transferred. There is a rule if you are a tax exempt entity that you can get a refund from the government. Key takeaways. And I don't know, Don, if you want to say a few words.
Yeah, that sounds good, Chad. Thank you for all that detail. And again, please follow up. I know it's a lot, but it's very exciting. I think that's one of the key takeaways. We've never seen this, right? And as we said, it's the IRA. There's 70 some, programs touched, tax codes. It's going to affect your multifamily product, credits, rebates, and so forth. It's complex, it's nuanced, but again, plan for it. It's around for 10 years. And we had one question here. These work so well in multifamily in general. There's one specific question, on section 42, these can all be added. These can be layered. There's no reduction in LIHTC eligible basis. So it is a huge, let alone the significant utility savings and just being a sustainable, product and so forth. So thank you for joining us. We'll get back to all of the questions that people sent in the chat. Really appreciate that. A lot of exciting things to be working on here and start planning. And just as we wrap up, just a quick consideration, please register for upcoming webinar entitled State of the Commercial Real Estate Market in 2023. The link will be provided in a polling question on the webinar attendee hub. Thanks again for joining us today.